Good morning, my name is Bakari. I'm a teacher for business studies, and today I'm going to tackle a Form 4 topic. That is the first topic in the syllabus, and as you can see here, that is the source documents and books of original entry. Source documents and books of original entry. Now, source documents by definition, these are documents from which original information is extracted. Original information for a transaction. When a transaction takes place, the documents that are issued by either the seller or the buyer. So these documents contain the original information concerning a transaction. So that is what source documents are. And example of source documents are, for example, cash receipts. That is produced by the seller when goods are bought on cash basis. So here I'm going to at least list some of them so that we discuss one by one. So the source documents, so first by definition, you can say source documents are documents from which original information of a transaction. Original information of a transaction is extracted. Examples, as I've told you, one of them is a cash receipt, which is born out of a cash transaction. That means goods are bought and the buyer pays cash. And that means the transaction is completed, so he will be given a cash receipt, which is evidence that transaction has been completed. So the other examples of source documents, apart from cash receipts, we have what is called a debit note. So the second example is a debit note. A debit note is provided by the supplier in case they want to. The supplier wants to correct an undercharge. That means maybe some goods were supplied, but maybe they have not been paid for, or there is a miscalculation and therefore there is an undercharge. So a debit note will be provided by the supplier to correct an undercharge. The other source document that we can talk about apart from debit note, we have a credit note. A credit note is a document that is provided or given by the supplier to the buyer in case they want maybe to correct an overcharge. That means there's an overcharge in the invoice. Therefore, that correction can only be done using a credit note. Apart from a credit note, we have an invoice. An invoice, on the other hand, is a document that is given out by the supplier again to the consumer or to the buyer to demand for payment for goods that have already been supplied. Then apart from that, we have what is called a voucher, petty cash voucher. We have a petty cash voucher. A petty cash voucher, on the other hand, this is a source document that is provided by a petty cashier to anybody who will be given money by the petty cashier. So it is signed by the people who take the money from the petty cashier. So that is what is referred to as a petty cash voucher. So those are some of the source documents that we have. Now on the other hand, books of original entry. So by definition, books of original entry can be defined as the books on which the information from the source document is first recorded temporarily before the information is transferred to the books of accounts. So examples of these books of original entry, we have the sales journal. Sales journal will contain information of sales goods that have been sold on credit. So the source document here will be the invoice. Another one is the opposite, which is the purchase journal. Purchase journal is also a book of original entry in which information concerning goods bought on credit are recorded. Apart from that, we have the sales return journal. When goods are returned to the seller, the information is recorded in a sales return journal. Then we have the purchase return journal. Purchase return journal, on the other hand, that is where the goods that are returned by the business to the supplier, that is where that information is recorded. Then on the other hand, we have the general journal. Now general journal is another book of original entry, or sometimes called a subsidiary book, in which the information recorded concerns rare transactions, like for example purchase of fixed asset on credit, sale of fixed asset, correction of errors. All those are recorded in the general journal. The other journal are the opening entries and closing entries. These are books on which information that is recorded will be needed when the business maybe is reopening or it is closing down, so that the owner goes for maybe a vacation. When he comes back, the information will help them to know where to start from, or will give the details, the financial status of the business at that time. So those are some of the books of original entries that we have. So let's look at how to record this information in the books of original entry. I'm going to give a summary of how to record them, so that the summary for a student will use it to, if you go through your notes, you'll see that the summary will help the student understand how to record this transaction. For example, if I take an example of, for example, the recording of transactions, so recording of transactions in books of original entry. Let's start with the first one, which is the sales journal. Sales journal. Now the sales journal is the book of original entry, whereas the sales journal, the source document for the sales journal, source document will be the outgoing invoice. Outgoing invoice means the original, or you can also call it the original invoice. So to record transactions here, example, we can assume that maybe goods were bought from the goods were sold to different customers. To customer A, so we call this maybe customer A, B, C, and A again. These goods were sold to customer A, were worth maybe 10 shillings, 20 shillings, 30 shillings, and 40 shillings. Now this source documents always have numbers, so we'll have invoice number. For example, this will be 001, 002, 003, and 004. So this is the part for invoice. These are invoices. Now these invoices, for us to post the transaction, the first document where it will go to is called the sales journal. Now in the sales journal, we'll have the amount column. The amount column, let's say we just write there shillings. Then we are going to have the date there. Maybe the date also, we can fix the date. This one maybe was sold on the 1st. This is 1st, 2nd, 3rd, and 4th. So the first document here, first you'll have the details here. So then you'll have the invoice number. Then you'll have maybe the invoice number. Then you'll have the sales, the journal. Then you'll have the amount here, column, so in shillings. So if we look at this, maybe on the first date, maybe it was 2001, maybe January 1st, goods were sold to customer A. And how much was it? Maybe invoice number 001. Sales journal, here we have the ledger folio, maybe sales ledger or sales journal. We can have a sales journal, maybe you can give it 1. Then here the amount was 10. Then on the second, B002, sales journal, maybe 02. Then here we have, this is a ledger folio, so this is a sales ledger. Then here we have maybe 20. 3 we have C003, sales ledger 3. Here we have 30. Then again on the 4th you sold to A, 004, sales ledger 4, 40. Now with this, from here now we can see this is 30, 60, 100 in total. So this is the total. You can say this is the total sales for that, total debtors. So this has to be posted to the journal. This information now has already been posted in the journal. Now for us to post it in the books of account, the books of account that we can have will be found in different ledgers. So you'll have a general ledger, and in the general ledger we are going to have the sales account. Now of course we also have the sales ledger. In the sales, we can put the sales ledger here. Sales ledger. In the sales ledger, we'll have the accounts of each customer that was sold to. So here we have customer A, B, C. So how do you post these transactions? The sales account will have, because sales is losing, we still have to follow the double entry here, and this will come from here, and this is from the sales journal 100. It will be posted on the credit side. Then because you are selling to your customers, customer A, B, C, their accounts are going to gain. So you write, for example, on the first January, there we have from the sales journal, we'll have on the 1st, we can see there this customer received 10 shillings, or both goods worth 10 shillings. on credit. Now, on the fourth again, from the sales journal, he received goods worth 40 shillings. When you come to B, the same thing applies. On the second, B received from the sales journal goods worth 20. And on the third, sales journal goods worth 30 shillings. So this is how the posting is carried out. And this is just a skeleton. If you look at the syllabus book, you'll find this one has been explained in so many pages. But you can take it the way it is and try to go through the notes, and you'll find that whatever I've done here, this is it explains a lot that has been explained in the syllabus book. So here, this is for sales journal. How about if it was purchase, goods were being bought? Now, if goods are being bought, everything will change because you follow the double entry. So what is going to change here is this column. This column now, invoice will remain, but if you look at, because you're selling to different people, yeah, or because you're buying because here you're selling to different people, the invoice numbers will follow each other consecutively. But when you're buying from different people, the invoices are not going to follow each other consecutively. It's going to be they are going to follow each other in a different way. For example, you're buying from A, the invoice will be 00, maybe 2. Here will be 0, maybe 4. Here 200. You never know. Here maybe 100. Again, because you're buying from different customer. So whatever, the other thing that is going to change is this place here. We are going to have now purchase journal, and the column here again will also change. This column now will have, this was changing, this will be 002, this will be now here the sales ledger here should remain the same. What is going to change here now? We are going to change this one also. The purchase journal is going to change. So the purchase ledger. Now the purchase ledger, these numbers tells you that this is still the same person. So here we'll have B, you're buying from B 0004. This is what was bought from B. From C, it is 200. And from A again, it is 100. So, the other thing that is going to change is here. These one now will no longer be sales, but will be purchase ledger. Then here again, this one will also have to change. This will be purchase account. Now, the other thing that will have to change is this one, because now you're buying. If purchase is being done, so we are going to receive the amount. So here we'll have the purchase from the purchase journal. This will come here now. Then these customers that you're buying from, the suppliers, their accounts are going to lose. So it's going to be we are going to have the accounts losing. So going to the purchase journal, this will be 10. Purchase journal on the 4th, on the 1st, it will be 40. Here purchase journal will be 10. Purchase journal here will be 20. Here purchase journal will be 30. So as you can see, this is the posting that is done in the book of original entry. The most important thing that you have to put in mind is the column for the source document. It is this information here that differentiates the different types of books of original entry. For example, if maybe we talk about returns, when goods are being returned, this column here will change. When goods are being returned, now we are going to have this one as a credit note. That will be a credit note. And you're going to realize that when you post the transaction for sales return, now this will be sales return journal. You realize that it behaves exactly like the purchase journal. Information will be the same, but here now we are going to have the sales ledger, sales ledger, sales ledger, sales. This one will change to sales, and this one will also change to the sales. This will be our sales, our sales ledger. Yeah, this will be sales ledger, and for general ledger we'll have sales return account. Now these people, these customers will be returning goods to the business, so their accounts are going to be losing. So this will be sales return, sales return, sales return journal. It will be the sales return journal. You realize that it will remain the same. It will remain the same, only that now the documents, the source documents will follow each other consecutively. For example, now here we are going to have 001, 002, 003, and 004, because the document is being issued by the business to the customers who have returned the document, the goods or the products. So that is how to post. That is how to post transactions in a journal or books of original entry. So a recap of what you have just done. We are saying that this, by definition, sales journal or books of original entry are subsidiary books in which information concerning a transaction which is found in the source document is first temporarily recorded there before it is posted to the books of account, which are the ledgers. And source documents are those documents from which original information concerning a transaction is extracted so that it can be posted in these books of original entry. Now, apart from that, these are just some, we have just looked at like 2 or 3 books of original entry. The other books of original entry are, for example, the general journal. General journal is a book of original entry in which transactions that concern sales of fixed assets on credit or purchase of fixed assets on credit are recorded. For example, if you buy, so let's look at the general journal. If you buy fixed asset on credit, a general journal will look like this. General journal. If you buy goods on credit, if you buy a fixed asset on credit, you have to record it, and the rules are very simple. The account to be debited comes first. So here we'll have the debit, credit, shillings there. So these are the details. And here we have, we can have the date there. So if you buy, for example, if you buy a car on credit for maybe from Cooper Motors, Buy a car worth maybe shillings for 100,000 from Cooper Motors on credit. This information will affect two accounts naturally. We know when you're using double entry, the first account that is going to be affected is the asset car account. And therefore, since the asset car account is gaining, we'll first write it there, the car or motor vehicle. Then we write there, we post it as 400,000. Then the account that is credited, that means where the vehicle is coming from or where it is bought, is the Cooper Motors. And Cooper Motors has to be credited. Now, one thing you have to note here is that the account to be debited is at the margin, while the account to be credited just 2 fingers away from the margin. Then the narration follows. You have to write here the narration, which is this is in record of purchase of a car on credit from Cooper Motors. Then you underline like that to move to the next transaction. So remember, when you're recording a general journal, it's just the same way we record transactions on ledger accounts. And therefore the account, but remember the account to be debited has to come first, followed by the account to be credited. For example, now if there's a sale, maybe of furniture, sales of furniture worth maybe worth 3,000 to Juma at 4,000 shillings. That means there's a profit that has been made. Furniture has been sold to Juma. Furniture worth 3,000 has been sold to Juma for 4,000. That means there's a profit that has been made. In such a case, we have to show the profit also. Profit is a gain. So here first, to whom, which account is supposed to be debited? You'll see that it is Juma's account. Juma's account there to be debited. By how much? Juma will be debited by 4,000. Then the account to be credited is furniture account. And furniture account, first you have to show the value of the furniture, which was 3,000. Then the gain will be shown as 1,000. That is the profit. The gain is actually the profit to be shown there as 1,000. So that is how to record in case the business makes a profit. But in case the business makes a loss, then the amount that appears as a loss will be indicated on the debit side. For example, if maybe now the business sold maybe a computer worth, business sold a computer worth 5,000 shillings for 2,000 shillings to Sally. If you look at that transaction, a loss has been made. And since a loss has been made, for you to record that transaction, you will first show how the account to be debited, which means the account to be debited, the person will gain an amount worth 3,000. So we'll have Salim as the person who receives that computer. Will get first the computer at which was supposed, the computer was supposed to be sold at 2,000, but it was sold at 5,000. So it will be, Salim will get the value of that computer, which is 2,000 plus. There'll be, 5,000. Then if I have to record it here, let me just wrap this one here so that I record it in a clear place. So Salim will get the total value of the computer, 5,000. Then the computer account which the business computer it was worth 5,000, but it was sold for 2,000. So here we'll have 2,000, but there'll be we'll have a loss because the computer is losing. Salim will gain the computer, we'll have a loss of the computer is worth 2,000, then a loss of worth 3,000 there. But this loss, because Salim is gaining the computer, so there'll be a loss here. Loss that has been 3,000 there. The computer was worth 5,000. The computer was worth 5,000 there. So that is how you're going to record that. There'll be a loss of 3,000. Salim, who we will sell the computer to, will only spend 2,000. The computer is supposed to be 5,000. So therein, you have to also record, you have to write the transaction, what has happened, and that is what is called the narration. So you can say, this is in record of a sale of a computer to Salim on credit at a loss of 3,000 shillings. Now, that is another book of original entry, which is called the General Journal. Apart from that, General Journal, as I said, apart from recording sales of fixed assets, because you remember we said General Journal is used for recording rare transactions that occur rarely. That means like sales of fixed asset, purchase of fixed asset. So if it is purchase, again, the recording will just go according to the way the accounts are affected on the General Journal. So apart from that, we also have the General Journal being used maybe to correct errors. The General Journal can be used to correct errors. So the General Journal, when correcting errors, it means that if an error has been corrected, and these are errors that will affect the trial balance, or the ones that will not affect the trial balance total. So either the errors have to be recorded here. For example, if there's a correction of error that has been done, that correction has to be recorded somewhere so that in future it aids your memory to remember what you did. Because if you look at the importance of these books of original entry, one of the importance is it helps you with details of transactions that took place. Yeah, it gives you a lot of details so that it's not easy. It aids your memory so that in future you remember exactly what you did. And this is used to avoid erasing and rubbing and correcting with maybe correction ink or something like that. So the general journal is used for that purpose. Recording of very rare transactions like the sale of fixed asset, purchase of fixed asset, correction of error, and also apart from correction of error, we can also talk about sales of fixed asset there. Okay, so those are some of the books of original entity that we have covered today. We have covered the one, we have covered the sales journal. We have covered sales return journal. We have covered the purchase journal. We have covered the purchase return journal. Remember, you should note this with their source document. This is for recording goods that are returned inwards. This is used to record return inwards or goods returned. And what about the source document? So you should know the source document here. Source documents here, we can talk about the source document for such a journal. Here is the outgoing invoice. Here, this is for recording. No, this is, I'm sorry, this is for recording sales on credit, when goods are sold on credit. Then this is for sales return. That means return inwards. Therefore, the source document here, this is a credit note. That means outgoing. This one here, purchase journal, is for goods bought, for recording goods bought. The source document here is the invoice, incoming invoice. Then we have, apart from that, we have the purchase return. This is for recording goods returned to customers, to suppliers. Here the source document here is the incoming invoice, incoming credit notes. Now, if goods are bought, the other journal that we are not maybe going to have enough time to go through is the cash receipt journal. Cash receipt journal, that means you're recording all the information about goods that have been sold and they have been paid for cash. So this is cash sales. So here we'll have a receipt, a cash receipt. Then you have the cash payment journal. Cash payment journal. So this is just a summary of what you have done there. Cash return journal. This is for cash purchases. Cash purchases. And the goods, here we'll have we'll still have to issue a receipt. And the receipt here will be, because this is cash purchase, the receipt will be incoming. Incoming is the original. This will be outgoing. Outgoing receipt. Then we have the general journal. General journal is for recording purchase of fixed assets or sales of fixed assets. So here, what you're going to have here, the source documents, because this the source documents here are the source document for the general journal are the information about what you get there. So we have the petty cash book, which you're going to handle next time. So next time we are going to look at two major books of original entry, that is the 3-column. We are going to look at the 3-column cash book, and apart from that, we also have to look at the petty cash book. The petty cash book. We also have to look at the petty cash book. Yes, the petty cash book this will require some time to explain these two. So we are going to look at all the cash books. In fact, we just look at all the cash books as we deal with the 3-column cash book. So we are going to start with 2-column cash book. We are going to move it to the 3-column cash book, and even the single. If you want, we can do that again. But these are the major books of original entry. So what is the importance of this? Importance of books of original entry. One is that it gives you the details. You have details of the transaction. Secondly, it will give you the books of original entry will give you information required. Information required for the final document, final accounting document. While the importance of source documents will be, this one is evidence, gives you evidence. It also aids memory, aids your memory, and source of information required, source of information. So with that, we come to the end of this chapter. So next time, although we have not finished all of it, we shall do the petty cash book to finalize this chapter. Thank you very much.